Hello viewers, welcome you all to my channel. I'm Hasham Ali Khan. Now I'm going to continue the explanation about ratio analysis. Last 2-3 videos I have completed. The first video I have explained you about the meaning of the term ratio. What is ratio analysis? What are the uses of ratio analysis? What is the importance and advantages of ratio analysis, limitations of ratio analysis, classification of ratio analysis. All these things I have explained in the first theory video on ratio analysis. The next video I have explained you about the formulas. According to functional classification, the ratios are classified into liquidity ratio, capital structure ratio, activity ratio, and profitability ratio. So in the last video, I have explained two ratios, that is liquidity ratio and capital structure ratio. Liquidity ratios are those ratios which shows the short-term solvency position of the business. Whether the business can be able to pay the current obligations on time or not. Whether current assets are sufficient to pay the current liabilities or not. That is liquidity ratio. So three liquidity ratio, current ratio, quick ratio, absolute liquid ratio. Along with the formulas I have explained. Then secondly, capital structure ratio or leverage ratio. This ratio shows the long-term solvency of the business, the proportion of owner's capital and borrowed funds. That will be explained in this second, capital structure ratio, long-term solvency ratios. Under this capital structure ratio, I have explained in the last video, debt equity ratio, proprietary ratio, capital gearing ratio, fixed assets ratio, then interest coverage ratio, dividend coverage ratio, debt service period. So these are the ratios which comes under capital structure or leverage ratios. So the problems are based on this theory. So if you watch this theory with willful concentration, definitely you can easily understand the problems. Otherwise, every problem of ratio analysis will be difficult for you. So my suggestion, don't ignore these videos, starting 3-4 videos I am uploading on the complete theory. And apart from that, in examination, they may ask you the theory also regarding ratio analysis. So if you watch with full concentration, definitely you can write excellently in your examination. Now, before starting these activity ratios, take a screenshot of the points which I have written on the board. Then I'll explain all the ratios which come under the category of activity or turnover ratios. Now see, third ratio is activity. The activity ratios measure the efficiency or effectiveness with which the resources or assets are used in the business. A business will use so many assets or resources. How effectively the business is using the resources, that can be known by using these ratios called activity ratios or turnover ratios. So what are the important activity or turnover ratio? The first ratio, which is very important, is inventory turnover ratio or stock turnover ratio. Both mean same. We can call it as inventory turnover or stock turnover. So inventory turnover ratio indicates how frequently we are converting the inventory into sales, stock into sales. So a business concern will hold the stock, will purchase the inventory, and after a lapse of time, after a period of time, the stock will get converted into sale. So this inventory turnover ratio shows how many times in a year the business can be able to convert their stock into sales. That is the meaning of the term inventory turnover ratio. It indicates the number of times the stock has turned over into sales in a year. That is a specific meaning. Now, inventory turnover ratio, ITR, the formula is cost of revenue from operations divided by average inventory or average stock. You can call it as inventory or you can call it as stock. Both mean same. So what is the formula? The cost of revenue from operations. It is nothing but cost of goods sold. Earlier it was known as cost of goods sold. Now it is named as cost of revenue from operations divided by average inventory. So first of all, what is this cost of revenue from operation? Two formulas are there to calculate cost of revenue from operation. The first formula, cost of revenue from operation is equal to revenue from operations minus gross profit. So you have to remember the formulas. Better you take a notebook, so whenever I explain something, immediately you write it down. Then only you can be able to get the good command on the subject, on the topic. Otherwise, it will be very difficult. So cost of revenue from operations is equal to revenue from operation minus gross profit. Actually, what do you mean by revenue from operation? It is nothing but sales. So sales minus gross profit, you will get cost of goods sold. So instead of saying cost of goods sold, we are saying cost of revenue from operations. Name changed, nothing else. And the alternate formula for cost of revenue from operation is cost of material consumed. Cost of material consumed plus stock adjustment. That means opening stock and closing stock we compare. And then adjustment for stock that will be added, plus operational expenses. Operational expenses means the expenses incurred to manufacture the goods. Direct expenses. Direct expenses are the operational expenses. So again I repeat, inventory turnover ratio is equal to cost of revenue from operation divided by average inventory. And cost of revenue from operation means revenue from operation minus gross profit, or one more formula is there. The other formula is cost of material consumed plus stock adjustment plus operational expenses. So according to the information given in the problem, that formula will make use. Now, alternatively, sometimes in the problem, the data will not be sufficiently given. That means we cannot be able to find out the cost of revenue from operation. The cost of revenue from operation we cannot be able to calculate because the data is not given. In that case, alternative formula we can use. The numerator, instead of taking cost of revenue from operation, we can simply take revenue from operation. But this is emergency formula. If we don't have the information, then only we apply this formula. Otherwise, if you have the information, always go by the original formula. This is the duplicate formula, alternative formula. So if we don't have the sufficient information to calculate cost of revenue from operation, then we take revenue from operation. And denominator is average inventory. Average inventory means opening inventory plus closing inventory divided by 2. Opening inventory plus closing inventory divided by 2, or opening stock plus closing stock divided by 2 is average stock. But if in some problems opening inventory is not given, when opening inventory is not given, we cannot be able to compute the average inventory. In that case, denominator will take closing stock. So what is the alternative formula? Inventory turnover ratio is equal to revenue from operations divided by closing stock or closing inventory. Now, inventory turnover ratio can also be expressed in terms of number of days. Here what we got the inventory turnover ratio is times. That means in 1 year, how many times we can be able to convert the inventory into sales. So this formula, if you apply this formula, you will get the ratio in times. But if you want the ratio in number of days, we can find out the inventory turnover ratio in terms of number of days. So how to calculate? The formula is effective number of days, working days in a year. how many are effective number of working days excluding the holidays, excluding the days on which working was not done. So only effective number of working days in a year in numerator, denominator inventory turnover ratio. Whatever inventory turnover ratio we get, that inventory turnover ratio we will take it in the denominator. Example, suppose the inventory turnover ratio you got 10 times. 10 times inventory turnover ratio. And number of working days in a year are 300. Working days, the number of effective working days in a year 300 and inventory turnover ratio 10. So 300 divided by 10, 30 days. We got inventory turnover ratio as 30 days, meaning we can be able to convert our inventory into sales every 30 days. That is the meaning. So an inventory turnover ratio of 8 is considered as ideal. The normal standard, normal ideal inventory turnover ratio is 8. That means in 1 year, 8 times inventory should be converted into sales. That's it. The first turnover ratio I have explained, that is inventory turnover ratio. The second turnover ratio is receivables turnover ratio or debtors turnover ratio. Traditionally, we call it as debtors. Now, we will not call debtors, we call it as receivables. So, in reality, receivables and debtors are one and the same. So, earlier we call it as debtors turnover ratio. Now, we call it as receivables turnover ratio. So, receivables turnover ratio shows how many times we can be converted our receivables into cash. That means how many times the debtors are paying us the amount. How many times in 1 year? In 1 year. So, receivables turnover ratio expresses the relationship between trade receivable and sales. Then it is calculated as follows. So, receivables turnover ratio is equal to credit revenue from operations. Actually, revenue from operation means sales. Then credit revenue from operation means credit sales. The numerator will take credit sales. Denominator average receivable. Average receivable means opening receivable plus closing receivable divided by 2. Or opening debtors plus closing debtors divided by 2 is the average debtors or average receivable. Now credit revenue from operation means credit sales, net credit sales, and average receivable opening trade receivable plus closing trade receivable divided by 2. Now receivables include debtors and bills receivable. While calculating this receivable turnover ratio, the receivable means debtors as well as bills receivable. The bills receivable should be added to debtors to find receivables. The receivables turnover ratio can also be expressed in terms of number of days, just like inventory turnover ratio. Inventory turnover ratio can be calculated in terms of times or in terms of number of days. Similarly, receivables turnover ratio can also be calculated in terms of times or in terms of number of days. So if you apply this formula, you will get receivables turnover ratio in times. After getting the receivables turnover ratio, you can find out how many days. How many days we can be able to convert our receivables into cash. For that, use the formula number of effective working days in a year divided by receivables turnover ratio. Number of effective working days in a year divided by receivables turnover ratio. Here is the formula. So, a high receivables turnover ratio or a low debt collection period. This formula number of days what you get is called debt collection period. That means calculating the receivables turnover ratio in terms of days, that is called debt collection period. So if you have a high receivables turnover ratio or low debt collection period is indicative of sound management policy. That means if you have a high receivables turnover ratio or low debt collection period is indicative that the business follows a good management policy. Next, a receivable turnover ratio of 10 to 12 and a debt collection period of 30 to 36 days is considered as ideal. So what should be the ideal receivables turnover ratio? So many authors says normally the receivables turnover ratio should be between 10 to 12 times in a year. Or if you collect debt collection period, the debt collection period should range from 30 days to 36 days. That's it. So I have explained two turnover ratios, stock or inventory turnover ratio and receivables turnover ratio. The third ratio is payables turnover ratio. Payables means creditors, the amount to be paid to the supplier of goods, supplier of material. The payables turnover ratio express the relationship between trade payable and purchases. We have purchased the goods from suppliers and the amount is payable. So it shows the relationship between trade payable and purchases. Now it is calculated. What is the formula for payable turnover ratio? The payable turnover ratio is equal to net credit purchases or the cost of material consumed. Net credit purchases or cost of material consumed divided by average payable. So how to find out this average payable? Opening trade payable plus closing trade payable divided by 2. By using this, we can be able to get average payable. Now payable include creditors and bills payable. Just like receivables. Receivables include debtors and bills receivable. Whereas payables, here payables include creditors and bills payable. And payables turnover ratio can also be expressed in terms of number of days, just like the inventory turnover ratio and receivables turnover ratio. Payables turnover ratio can also be expressed in terms of times or in terms of number of days. By using this formula, you will get in times. Now, how to calculate the payables payment period? This is called debt collection period. Debt collection period, number of days required to get the amount from receivables. Now, how much is the time period to make the payment to payables? The payment period, payables payment period is equal to number of effective working days in a year divided by payables turnover ratio. Here is the formula. Number of effective days in a year divided by payables turnover ratio. This is called payables payment period. That's all. The three ratios I have explained: inventory turnover, receivables turnover and payables turnover. The next ratio is working capital turnover ratio. Working capital is the difference between current asset and current liability. So working capital is equal to CA minus CL. So here working capital turnover ratio, the formula is cost of revenue from operations, or simply we can call it as cost of goods sold. So cost of revenue from operations divided by working capital, and working capital means CA minus CL. So a high working capital turnover ratio indicates efficient utilization of firm's fund. So a high working capital turnover ratio indicates that the business is effectively utilizing its funds. Now fixed assets turnover ratio, this is the fifth one. The formula is revenue from operations, that is sales, divided by fixed assets. So here a high fixed asset turnover ratio indicates better utilization of firm's fixed assets. How effectively we are utilizing the fixed assets in the business. A high ratio is desirable. So if a ratio of around 5 is considered ideal. So some author says it is not a rule, thumb rule, but it is general, idea that this fixed assets turnover ratio should be around 5. Now last one is total assets turnover ratio. The formula for total assets turnover ratio, revenue from operation divided by total assets, just like fixed assets. Here fixed assets turnover ratio, here total assets turnover ratio. In numerator we have taken revenue from operation, here also we will take revenue from operation. Denominator, there we have taken fixed assets, here we take total assets. Total assets includes fixed assets and current assets. Fixed assets plus current assets. The higher the total assets turnover ratio, greater is the ability of the firm to utilize the investment in the business. So a high total assets turnover ratio indicates that the business is utilizing the assets effectively. That's all. So in this video I have explained you about the third category of ratios, and that category is activity or turnover ratio. How effectively the business is utilizing its resources and assets. So important ratios are inventory turnover ratio, receivables turnover ratio, payables turnover ratio, working capital turnover ratio, fixed assets turnover ratio, total assets turnover ratio. Among these six, the first three are very important. The first three: inventory turnover ratio, receivables turnover ratio, and payables turnover ratio. The last one more category of ratios I have to explain, and that I'll take up in the next video. That is profitability ratios. So after completing profitability ratios, then we'll start the problems on ratio analysis. Remember, for your sake, I am saying again, you should not directly go to the problems until and unless you watch these theory videos not once, twice, 3-4 times you watch the video. You will be perfect in all the formulas, then easily you can solve the problem. Otherwise, it will be very difficult for you to follow the problems. Inshallah, we'll continue the profitability ratios in the next video.